Hi, good evening friends. In this video, I'll be talking about valuation. Valuation is a very important aspect, especially with reference to family businesses. Now, how many of us appreciate the importance of valuing our family businesses? Okay, before that, let's understand some of the big companies which we can recall. Tata Group comes to my mind, TVS, Aditya Birla, Kirloskar Group, Godrej, Shapur Palonji, Reliance. All these companies had fantastic valuations and they started very small, maybe close to 100 years, barring Reliance. And look at the place they have reached. But ever wondered how does one value such businesses? Let me tell you, it's no cakewalk to value a family business. In this video, I will be trying to showcase how we try to do that. And of course, these are basically the best possible methods available, but then you cannot really 100% reach a valuation because there will be different approaches which can be used. Okay, but before doing this, I quickly wanted to also share with you why valuation is important. Firstly, in case there is a merger and acquisition which one is looking at, so you should know the value of your company and value of the company which you want to buy. Valuation is important. Separation. If, for example, you are a shareholder, you're not happy with the business, want to separate, how much will you get, boss? It will depend upon the value. Who finds that out? Of course, you. If to attract capital outside or FDI, valuation. You have to reward your employee, ESOPs, listing, IPO, and of course, gifting or succession planning would require proper valuation. Now, what exactly I'm going to do here is I'm going to just share a few interesting things which one could look at and hypothetical examples. Now, if there is somebody who has assets ranging from land, from residential property, and somebody who invests into stocks, mutual funds, bonds, somebody who has a rental income or also income from business. So, how do we do his valuation? How do we find the current value of the business of that firm or family business? And how do we project the future value? So, firstly, we'll need to identify all these aspects as I mentioned: land, real estate, sorry, residential property, if the person owns, or rental income. Let's write down all of them. Then let's try to find out how do we value. Let's start with the first one. Let's say land. Now, let's say land is to be valued. Now, the key challenges could be the value of land. Um it's difficult to find only because markets are not perfect. So you'll need maybe a valuer to give you a rough idea. Then you'll have to go by the circle rates of that area. Maybe you will have to find through brokers what's the rate going on, the rate of a distress sale if you're doing, what would be the rate, or maybe some form of advertising could be required to get that valuation perspective. Valuing your rental income is easy because you can find out that this is a rental I'm getting from A source or B source. That can be easy. But then business income valuation or rental income valuation with the future, that means I'm assuming that all these things are going to remain with me forever, like a going concern, is very difficult because 5 years down the line, if I'm predicting my value of business and the business doesn't exist, how do I value that business, right? Similarly, for rental income, the tenants suddenly go. How do I value that business? Now, other things like investments, like I said, in bonds, mutual funds, you can track on a regular basis. Their various sites, or even gold, for example, if somebody is having. One can value them by simply going on the sites like various good sites are there. Money Control, Value Research gives you value of all these things, or some softwares are also available for tracking gold or other things. And also you can, using this, try to uh, make some projection in future depending upon the data. But one critical thing which I like to tell you again is that all these things which I've said now are based on certain assumptions. So while reaching valuations, you have to be very clear what assumptions you are making. Okay, first assumption which we all make is that market is proper, so you can get a reasonable value for whatever thing. What if markets are not proper, like a COVID time? How do you value? I'm just giving you food for thought. Ultimately, you will have to sit with paper and pen and try to do that valuation. Assumption, as I said earlier, that it's a going on concern. Things may change anytime. Then investments will fetch me a right price is debatable. What if they don't fetch you the right price? Suddenly, if there's some correction in the market or a situation. So how do I value? So you have to take that factor into account as well. And assuming that the economy and financial markets are doing well is the biggest, I would not say misnomer, but point which we have to consider. There can be good markets, bad markets, neutral markets. Okay, now I'll move to forecasting value for future business. So land, you can use previous year's data and try to form a trend. Similarly, for the rental income, you can do the same. You can try to find what has been my rental now, and let's say if there is a clause, you can try to reach a figure. For business income, you can do a SWOT analysis: strength, weaknesses, opportunities, threat, to find out whether my business will be fine after 4 years, 5 years, whether it'll be there or not. Investments, as I told you, so many softwares are there, and of course you can keep reading reports on equity, debt, how the things will move, and form your own set of assumptions. But of course they should be reasonable. For fixed assets, you can choose depreciation as whatever basis, either written down value or straight line method, depending upon the policy that you're choosing. Now, what if I've told you is basically a very simple thing. Now, there could be some complications also, like somebody's having a factory. So, how do I value a factory? In a factory, the valuation game will be very different because you have semi finished goods. Like, let's say somebody's having a ball bearing factory. How do you value it? The cost of steel may go up and down. The raw material, work in progress, have to be valued differently. So, that is a key concern which has to be kept in mind while valuing companies which are manufacturing companies. And business valuation would also depend upon things like profit, turnover of the business, the depreciation you are taking, valuation of finished goods, valuation of raw material. So this becomes a slight challenge for manufacturing. So coming to another level of issues, let's say your company is making uh, intangible things, like let's say if it's a consultancy, how do you value that consultancy? Because you're not producing any goods or services. So then the formula could be very different. It could be a certain percentage of the income which is being made, and let's say you extrapolate that for many years and reach a figure. Let's say if somebody is having goodwill, how do you value goodwill? There's no standard way of valuing goodwill. So that also has to be kept in mind. What is the fair parameters, or maybe other competitors, how they're reaching value, or a benchmark laid down by the market. So use that to value your company accordingly. So summarizing, valuation is not an easy bet. Then obviously there difficulty in arriving fair value of an asset. Book value of a firm is debatable. Amortization of expenses over fixed assets is difficult. Work in progress is something which you'll have to clearly understand and make your own policy, like I value resources at X or Y depending upon the policy I've taken. Future cash flow of your business, boss, is the most difficult thing to predict. But then if you see your business stable, then you can make some assumptions of growth. And most importantly, valuing intangible assets, goodwill, etc., patents. Okay, now I would be Giving you a small perspective of valuation of equity shares. Let's say a company has certain cash flow. So how typically in financial terms we value? We value basis the overall dividends or future cash flow which the company is generating, and then we try to take out the present value of that. In other terms, let's say my company is giving me 10 rupees dividend every year. So how do I calculate the value of that company? I will try to discount all the dividends which is expected in future by a certain discount rate and try to reach the value of my company. This gives me a rough idea as to what will be the value of my company by using dividend capitalization approach. This is one of the approaches. Then a lot of people also use PE or price to earnings ratio. That means market price to earnings to give you a valuation perspective. Then of course liquidation value is there. If I liquidate the company today, what would be the value? Or book value. There is a total book value of the assets. So these are some approaches which are there, which one can use. So finally, I would like to conclude by just saying that valuing your family business is critical. You should start it early. And to get a clear perspective of valuation, have a list of all the assets that are there. Then sit with all the adult members of your family and discuss what should be the way you should value the assets. Financial assets can be valued easily, but the non-financial assets are slightly difficult. Get a best case scenario, a worst case scenario, and an average scenario for valuing a business, and have transparency in your business to get better valuation. By using all of this, you can try to reach a reasonable value for business, and which I said in the earlier part of my speech, that this would help you in all your future endeavors for your business. Thank you very much for watching this video, and stay safe.